Monetary Policy Committee of RBI has decided to increase the policy repo rate under the Liquidity Adjustment Facility by 25 basis points to 6.5%. But why? Before we answer this question, make sure to like the video and subscribe to India Business Insights for more videos like this. On February 8, 2023, MPC decided to increase the policy repo rate with a 4:2 majority. Consequently, the standing deposit facility rate stands adjusted to 6.25%. The standing deposit facility is a collateral free liquidity absorption mechanism implemented by the RBI with the intention of transferring liquidity out of the commercial banking sector and into the RBI. It enables RBI to take liquidity that is deposits from commercial banks without having to compensate them with government securities. Because it was created to give Reserve Bank the ability to handle unusual circumstances when it must absorb large quantities of liquidity. Marginal standing facility rate and the bank rate also stand adjusted to 6.75%. Marginal standing facility is a window for banks to borrow from the Reserve Bank of India in an emergency when interbank liquidity dries up completely. It is a penal rate at which banks can borrow money from RBI when they are completely exhausted of all borrowing assistance. Bank rate, on the other hand, is the rate of interest which is charged by RBI while lending loans to a commercial bank. In the event of a fund deficiency, a bank can borrow money from the Central Bank of India. The borrowing is done as per the basis of monetary policy. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. The first advance estimates released by the National Statistical Office (NSO) on January 6, 2023 placed India's real gross domestic product (GDP) growth at 7% year on year for 2022 to 20, driven by private consumption and investment. The economy grew 9.7% in the first half, April to September of financial year 23. The first advance estimates of GDP by NSO have incorporated the factory output data of an additional month, October, as well as some lead indicators until November and December, assuming 4.5% growth. In the second half, that is October to March, the economy grew 8.7% in financial year 20. On the supply side, the gross value added was estimated at 6.7%. In financial year 23, agriculture is expected to remain the bright spot, growing at 3.5%, while electricity 9% and construction 9.1% are likely to see robust growth, driven by post pandemic recovery. Manufacturing 1.6% is expected to remain the laggard, weighed down by high input cost. The services sector, which comprises more than half the economy, is expected to grow at a robust 9.1%, proving to be the key driver of economic recovery. Higher rabbi acreage, sustained urban demand, improving rural demand, robust credit expansion, gains in consumer and business optimism, and the government's enhanced trust on capital expenditure and infrastructure in the Union Budget 2023 to 24 should support economic activity in the coming year. However, would be a drag on domestic growth prospects. Domestic demand has been sustained by strong discretionary spending. Urban demand exhibited resilience as reflected in healthy passenger vehicle sales and domestic air passenger traffic. Rural demand is improving. Investment activity is gradually gaining around. Non oil, non gold imports expanded in December. Merchandise exports, on the other hand, contracted in December on the weak global demand. Investment activity continues to gain traction. Non food bank credit expanded by 16.7% year on year as on January 27, 2023. The flow of resources to the commercial sector has increased by Rs 20.8 lakh crore during 2022 to 23, so far as against Rs 12.5 lakh crore a year ago. Indicators of fixed investment, cement output, steel consumption, and production and import of capital goods registered robust growth in November and December. In several sectors such as cement, steel, mining, and chemicals, there are signs that additional capacity is being created in the private sector. According to RBI's survey, seasonally adjusted capacity utilization increased to 74.5% in quarter 2 of 2022 to 23. The drag from net external demand, on the other hand, continued as merchandise exports contracted in quarter 3 of 2022 to 23. CPI headline inflation moderated to 5.7% year on year in December 2022, after easing to 5.9% in November on the back of double digit deflation in vegetable prices. On the other hand, inflationary pressures accentuated across cereals, protein based food items, and spices. Fuel inflation edged up primarily from an uptick in kerosene prices. Core CPI, that is CPI excluding food and fuel inflation, rose to 6.1% in December due to sustained price pressures in health, education, and personal care and effects. On a year on year basis, money supply expanded by 9.8% as on January 27, 2023, while non food bank credit rose by 16.7%. India's foreign exchange reserves were placed at US dollar 576.8 billion as on January 27, 2023. The Indian rupee has remained one of the least volatile currencies among its Asian peers in calendar year 2022 and continues to be so this year also. Similarly, the depression and the volatility of Indian rupee during the current phase of multiple shocks is far lower than during the global financial. The current account deficit for the first half of 2022 to 23 stood at 3.3% of GDP. The situation has shown improvement in quarter 3 of 2022 to 23 as imports moderated in wake of lower commodity prices, resulting in trade deficit. Further, services rose by 2% year on year in quarter 3 of 2022 to 23, driven by software, business, and travel services. Global software and IT services spending is expected to remain 23. Remittance growth for India in H1 of 2022 to 23 was around 26%, more than twice the World Bank's projection for the year. Owing to better growth prospects of the Gulf countries, the net balance under services and remittances are expected to remain in large surplus, partly offsetting the trade deficit. On the financing side, net foreign direct investment (FDI) flows remain strong at US dollar 22.3 billion during April to December 2022. Foreign portfolio flows have shown signs of improvement with positive flows of US dollar 8.5 billion during July to February 6th, led by equity flows. Net inflows under non-resident deposits increased to US dollar 3.6 billion during April to November 2022 from US dollars 2.6 billion a year ago. Foreign exchange reserves have rebounded from US dollar 524.5 billion on October 21st, 2022 to US dollar 576.8 billion as on January 27, 2023, covering around 9.4 months of projected imports for 2022 to 23. India's external debt ratios. The outlook for inflation is mixed. While prospects for the rabi crop has improved, especially for risks from adverse weather events remain. The global commodity price outlook, including crude oil, is subject to uncertainties on demand prospects as well as from risks of supply. The ongoing pass through of input costs to output prices, especially in services, could continue to exert pressures on core inflation. There is the Reserve Bank's enterprise surveys point to some softening of input cost and output price pressures in manufacturing. Taking into account factors and assuming an average crude oil price Indian basket of US dollar 95 per barrel, inflation is projected at 6.5% in 2022 to 23. With on the assumption of a normal monsoon, CPI inflation is projected at 5.3% for 2023 to 24, with quarter 1 at 5%, quarter 2 at 5.4%, quarter 3 at 5.4%, and quarter 4 at 5.6%, and risks evenly balanced. Stronger prospects for agricultural and allied activities are likely to boost rural demand. Strong credit growth, resilient financial markets, and the government's continued thrust capital spending and infrastructure create a On the other hand, external demand is likely to be dented by a slowdown in global activity with adverse implications for exports. Taking all these factors into consideration, real GDP growth for 2023 to 24 is projected at 6.4%, with quarter 1 at 7.8%, quarter 2 at 6.2%, quarter 3 at 6%, and quarter driven by a strong deflation in vegetables. The easing of inflation in last 2 months was driven by a strong deflation in vegetables. Headline inflation excluding vegetables has been rising well above the upper tolerance band and may remain elevated, especially with high risks, a major risk to the outlook. Domestic economy activity is expected to remain resilient, aided by the sustained focus on capital and infrastructure spending in the Union Budget 2023 to 24, even as continuing fiscal consolidation creates space for private investment. With the view that further calibrated monetary policy action is warranted to keep inflation expected anchored, the MPC decided to increase the policy repo rate by 25 basis points to 6.5% and to remain focused on withdrawal of accommodation to ensure that inflation